Good evening. Welcome everybody to episode 9 of the Presidio Perspective. My name is Dustin Tembrook, the president of Presidio Capital Management. It's just me here with you tonight. And so this is our 9th episode here covering what's going on with COVID and giving you our weekly update. So hopefully you have something planned after these weekly presentations to uplift your spirits. Of course, I was hoping to put together a presentation today. I was talking to Cheyenne, one of our team members, as we were putting this together, and kind of wanted a good, a bad, and the ugly theme. And I think I have a bad, a worse, and the ugly theme kind of going on week after week. So, we're just going to share with you the information that we have going on with the current disease, the economy, and kind of what the experts are talking about. So I just wanted to prepare you for that. But I'm sure you have lots of questions as you go through the week. Just know that we're here every week with you. So if you have those questions and you want to ask them, this is a great format for you to do it. Of course, you know how to get a hold of us. You give us a call at 858-461-4959 or send us an email. You can email me directly, or you can email info@presidiocm.com. But anyway, you probably have a lot of questions that a lot of other people do. So anytime throughout this presentation, you can use that Q&A box right at the bottom and go ahead and submit your question, and I'll do my best to answer as many of the questions as I can. We try to keep these presentations within about a 1-hour time frame. So I should have lots of time for a Q&A at the end of today. Also, we're working on putting together a little feedback email that we want to send out to all the past participants. So as you attend these, you might get an email from our team. I promise to make it really easy and simple to fill out, but we do want to just get your feedback on what you like or don't like, things that you'd like us to cover more on. Some ideas that we have for different panelists and experts that we can bring on. So we've talked about bringing on people from the medical community or political leaders, or more economists and investment managers, et cetera. We'll continue to bring on. I'm really excited for next week. We're going to bring back Chief Investment Officer of Cetera Investment Management, Gene Goldman. So many of you I know had a chance to see Gene live at one of our client events. So Gene is a frequent contributor to CNBC, Fox News, quoted in business periodicals quite often. So we have a great relationship with Gene. He's going to be joining us next week, sharing his thoughts. So we're looking forward to that. So I'm going to go ahead and share my screen with you with my slide deck that I have today. So hopefully you can see that okay. And then we'll start off with our lovely disclaimer as always. So remember that all investing involves risk. The risk of potential loss of principal. No strategy or product can assure success or protect against loss. And past performance is no guarantee of future results. And again, this is educational material that we're putting together for informational purposes only. So before making any decisions, please consult your tax, legal, or investment professionals for their respective advice. Okay. So tonight's theme, I think we have a long way to go. That probably could be of the theme for all 9 weeks in a row, but rest assured that when we think differently, we'll go ahead and share that with you. So although, it's hard to not share with you a lot of positive news week after week, you can be rest assured that if you keep tuning in and we are sharing good news, that you can believe it for what we're looking at. So we're going to talk about COVID-19 update. Again, the state's plan and the governor's plan to reopen California and where we are there, what the economic update is. So what are we looking at in the economy? We've had Jerome Powell come out and address the nation or the world today, which really sent markets lower. If you watch the stock market today, along with some other key contributors that we'll quote here. So talk about what's going on there. So the cases can continue to climb, kind of in lockstep with what we would expect. So globally, we're at, still over 4 million cases total. 1.6 of those have recovered. The death toll globally is reaching about 300,000. Again, this is with the reported data that we have thus far. One of the key interests that globally we're having is the city of Wuhan is actually seeing a reemergence of new cases, and the Chinese government has ordered to test the entire 11 million population. And the entire city has again been ushered into shutdown. And also other cities with potential new clusters have been completely sealed off. So, it's interesting. The world is watching, of course, what's happening in China here as they see a resurgence of cases and where this all started. And so when we're looking at, what's happening in other countries and where they are in their respective battle against COVID, they try to reopen economies. It's good for us to watch. And our economy and our political system and our way of life is very different than a lot of other nations as they all differ from each other as well. So it's not to say that that's what's going to happen here. But China obviously can take really extreme measures to shut down their economy and order tests of every citizen, where we just don't have that capability. We've talked about that in weeks past. Interesting also is that Taiwan has reported 0 new coronavirus cases. They've had 30 days without a locally transmitted infection. Again, this is a government that has taken really decisive and severe action in shutting down their own economy. The PBS NewsHour did a really good segment on how Taiwan was able to get ahead of this pandemic. So when this was starting in China and they heard of a SARS-like virus, they had sent their own scientists to Wuhan to kind of figure out what was going on. And I think there's a lot of distrust from Taiwan and China. And they decided to immediately close down all flights from China, and Taiwanese nationals were returning to Taiwan from China back to their home country. So they planned really well, and they're getting some benefits for that. So again, we're just looking globally at kind of what's going on over there as some of these reemergences happen, and we'll see what our nation's response is when those things occur. In the U.S., we have 1.4 million cases, and reported deaths now are over 84,000. So that number continues to climb at a rate that's way too high, and something that we're going to have to contain and get down to 0 here pretty quickly. So it seems like, again, a long way to go. What we're all hoping for is, of course, a vaccine. And a vaccine is when we're really going to have that confidence that you're going to see, we suspect, in the stock market, certainly the economy, and our own way of life. Again, when Americans are polled, a recent study says that 14% of Americans today say they would refuse to take a vaccine if it was available. So again, we're going to have our own challenges. I think Luke talked about last week the government's ability to shut the light switch off, but we lack the ability to turn it back on, and it's really going to be left to the American public of a lot of these decisions and what we're going to do as we reopen the economy. Places where you've seen reopenings of different states across the country. In Nashville, restaurants that were allowed to open were not opening. Many of them said that even at a 75% capacity, they weren't going to be able to survive. We'll kind of come back to this of what this means in our economy and kind of the recession that we're facing right now. But we thought that was interesting. Texas reopened in early May, and they're now seeing 5 days in a row with consecutive 1,000 new cases a day for 5 days in a row. So again, we're watching states reopen, kind of a resurgence of cases, and that's something that we've always kind of expected was going to happen. And I think the unknown is, what are we going to do to combat that? So this is kind of like this trial phase of reopening the economy in our view, and hopefully preparing us for the next flu season, that we kind of work out some of these kinks. It's kind of a light way to put it, but work out what we're going to do, how we are going to act as a civilization to help contain this disease without just completely shutting in the economy, because we're not going to be able to survive that economically if what we just did for the last month or two is what we're planning to do for 6 months the next flu season. So hopefully this is an opportunity for states and the American people to kind of test out what their social norms are and what they're willing to do and sacrifice to be able to slowly reopen business and commerce. Really interesting today is what I saw is that the Cal State University system, so including my alma mater, San Diego State University, they completely canceled all live classes through 2021, and that their entire curriculum is going digital and online through the end of next year. So I thought that was a pretty unprecedented move, and we'll see how much more of this kind of stuff is to follow in the days, weeks, and months ahead. But I thought that was pretty interesting. San Diego County continues to be a hotspot in the state of California. So LA, of course, is having the worst troubles. And some other counties are having a harder time. If you look at, cases per 1,000 in the civilization, I think Riverside and some other countries or counties are having some hotspots. But San Diego and Orange County, as far as a total confirmed cases, I believe are number 2 and 3 in the state. San Diego now, I'm looking at this. This data is from 2 days ago, where we had over 5,000 confirmed cases. And I believe we were all here a week ago, and we were looking at this number, and it was only 4,000. So if that's correct, that's a 25% increase in just the last week in new cases here in San Diego. What's also interesting is that 25% of the confirmed cases in San Diego require hospitalizations or intensive care, and that our ICUs right now are over 52% capacity. So that's pretty concerning. I said interesting. So the ICU capacity levels are certainly concerning to my view. The interesting part is that from my knowledge and what we've covered so far with COVID is that it doesn't result in 25% hospitalizations. And that leads me to believe that there are probably a lot more non-confirmed cases that we have in our respective counties. And I have even personally talked to individuals who have either themselves reported or know somebody who's reported that, they talked to their local medical provider and had the symptoms and were said, if you can stay out of the hospital, try to stay out of the hospital, and kind of, managed their symptoms and recovery on their own. So there could be a lot more unconfirmed cases in San Diego when I look at these numbers, but still the confirmed cases is what we track, and those numbers in themselves are something to note. Of course, this slope is pretty steep. We've seen an increase in cases, so something that we have to follow as we're talking about reopening the economy. It could be pretty challenging. So when we come back to Governor Newsom's plan, we've had a lot of kind of demand and unrest from the people. I've felt it certainly, and I know that I've talked to a lot of individuals, friends, and colleagues and clients that are kind of feeling the pressures of being cooped up and shut in. Lots of businesses are freaking out. I mean, it's hard to have visibility into the future and to be told that you can't go back to work. Elon Musk, of course, famously has been tweeting his battle and lawsuit with Alameda County as, they tried to force Tesla plants to remain closed. And he said, we're going to ignore that order. So, this is all playing out again in the court of public opinion and maybe in the state and local courts as well. So where we are right now is we're hoping to get more information about when restaurants are going to be able to reopen. The governor has said that schools could potentially reopen this summer under some modifications. However, given what we've just seen from the state universities, I'm not sure what we're to expect there. But what remains closed are offices, shopping malls, dine-in restaurants, all still ordered to shut in. Of course, personal grooming businesses, entertainment venues, concerts, sports are not included in the first, 3 phases actually of reopening the economy. So still, we're a long way off from seeing anything there. Also, non-essential businesses are starting to reopen for curbside pickup. So I don't know if anybody out there has had any experience in doing your curbside pickup, but so long as you adhere to distancing and infection control protocols, businesses non-essential businesses have been able to reopen. So book and music stores, clothing stores, florists, sporting goods stores. As I look at this list of non-essential businesses, I kind of worry about these non-essential businesses being non-essential. Actually, if I look at this list, it seems like all of these were already under some pressure to, kind of exist in a pre-COVID world. So sporting goods stores, toy stores, bookstores have been going bankrupt for years. So we'll see how many non-essential businesses remain that way even after COVID. But this, of course, could be a death blow to a lot of these industries, which have a lot of jobs and local businesses attached to them. So, it's a very trying time for struggling businesses to go through this recession right now. Golfers, I know I've talked to you, some of you out there, some of our avid golfer clients and friends and colleagues, of course, have gotten back out to the golf course last weekend, had your temperature taken or signed your own card, or you had to walk the course. So some people have been able to do that. Trails and trailheads, parks have opened up. And again, we're supposed to, the rules remain, wear a face covering, wear your face mask when you're out there in public, wash your hands throughout the day, and stay 6 feet away from people who don't live with you. So those are the best things that we've come up with so far to try to protect the spread of this disease once we kind of get out there in the public. But again, a long way to go for us to see any kind of normal existence that we're accustomed to, and to do all the things that we love about going out to eat and going to malls and office buildings. And, my wife and I have an anniversary coming up in about 30 days. And see, honey, I didn't forget. And we're trying to plan what we're going to do for our anniversary. And it's hard to plan. I'm sure many of you have had that same thing. So to get back to this area where you can go out to dinner, go shopping, go to the mall, go to the movies, what we're having to show, some of the quantitative measures from the governor's office is no deaths in a 2-week stretch. So we're certainly a far way off from that, but that's what we have to see. Also, just one new case per 10,000 of a population in a 2-week stretch. So again, a long way to go on that one. Robust testing and tracing. So we'll do a little bit more research for you and bring that back in future webcasts about what that means. Robust is a pretty subjective term. But obviously a lot of testing and tracing needs to occur. And then the ability for respective cities to house up to 15% of the homeless. So this was not something that was on my radar prior to today, but something that apparently we need to do, as the individual cities and counties are going to have to show that they can do these things for them to reopen their local businesses and their economies. So we promise to track these things going forward. So my team out there, make sure that, we track these going forward in our Presidio Perspective, and kind of bring to you the metrics that we're watching. And if any of these metrics change, we'll of course communicate to you as well, because we're all here in California, of course, very interested in these things from just a way of life perspective, not just on what's going on in the economy and of course the stock market. On that note, we'll go ahead and so I guess that was the good news portion of the webcast here. So again, just brace yourself. So the economic update. So COVID-19, the economic impact continues. So again, I alluded to before, Jerome Powell kind of gave some sobering remarks to the world this morning, talking about just the current situation that we're in and how challenging it really is for our economy. They promised to publish a survey tomorrow where what they have found is that of American households which make $40,000 or less, 40% of them lost their job in March. That's a pretty staggering statistic right there. Went on, lots of comments I'm going to share with you here, but he also went on to say that the scope and speed of this downturn is without modern precedent. Of course, I believe we know that, significantly worse than any recession since World War II. And that was a pretty strong statement from the the chair of the Federal Reserve, just acknowledging that this is the worst we've seen in 75 years as a country. And that's what we are living through right now. He went on to encourage that additional fiscal support could be costly, but is well worth it if it helps avoid long-term economic damage and leaves us with a stronger recovery. So what he's talking about there is that the sense that we got is that, the Fed is committed to using every weapon in their arsenal to help soften the blow of this economic recession that we are experiencing right now. However, that their monetary policy would not be enough, and that would also need to be matched with additional fiscal policy and support like we've seen from Congress. And so essentially he's calling for more of it and saying that, where we are right now in this recession is we have a lot of challenges ahead, and that it's going to cost us as the American taxpayer, the federal government, what have you, it's going to cost us a lot of money, but it's going to be worth it if it's going to keep us out of a depression. And so, we are kind of at this point where, we can have a long road ahead of us. And we really haven't seen, the really challenging parts of recessions and economic contractions is where you have the closed for business signs, vacant signs, permanently closed signs going up. And there's, thousands and thousands of businesses that will completely go out of business. We know that that's part of a recession. We know that that's coming, and that it takes, the more that happens, the harder it is for the economy to recover. He also talked about, just what happens when you lose your job and you're out of the workforce for an extended period of time. And that time is really, not our ally on this. And as the recession kind of wears on and it takes longer to open up the economy, that it's going to continue to get worse the longer that happens on this decline. And which is typical of all recessions, we know that. But he's just kind of underscoring the point that, when somebody loses their job and is out of the workforce, which we'll share the numbers with you, they're staggering. And they're out of the workforce for a long time, they might not ever be able to kind of recover that gainful employment they once had. If you're out of the workforce for a long time, those skills that those workers possess become less relevant. And you lose the skills if you're not using them. So if you're out of the workforce for months and months and years, there's new skills that the workforce demands that you might not be accustomed to. You might be out of practice with your skills. Networks are broken down, and it's really hard to go and replicate those jobs. He also spoke about the small and mid-sized business owners, and that the loss of thousands of small and medium-sized businesses across the country would destroy the life's work and family legacies of many business and community leaders and limit the strength of the recovery when it comes. I was talking to one of our team members, Luke Jacobson, who was on with me last week, about some of his experiences that he's had in this respect. And he was kind of underscoring his concern about this as well, where he was talking to a local gym owner who owns some, runs a very successful business and fitness and owns, many well-run gyms in the county. And they're saying that they need to reopen for business on June 1st. And, kind of questioning whether we're going to be able to do that. But essentially, they were saying that they don't, staying closed for months and months at a time is not even an option. Like we just won't be able to do that. So we really have some challenges when it comes to the local small and mid-sized businesses or small and mid-sized businesses across the country to make sure that they can stay in business. And again, time is not our ally. And as those go on, without that fiscal and monetary support, it could get really bad. So I think kind of his final point is the recovery may take some time to gather momentum, and the passage of time can turn liquidity problems into solvency problems. And liquidity problems is what we've been trying to solve through our fiscal and monetary policy to date. So liquidity problems are saying your ability to pay the rent, your ability to meet payroll obligations, to pay your vendors, those kinds of things are liquidity problems. Our business in a whole is intact, but to get through this little period, we have some liquidity, some cash on hand problems that we need to solve. So that's relatively easy for monetary and fiscal policy to create measures to help provide liquidity to the market. So the Fed keeps interest rates really, really low, has continued their bond buying program, which essentially just allows banks to be well capitalized and allows lenders to feel like they can continue to lend. And so, that has solved some of the liquidity problems. But what happens when you don't have that demand for that business on the other side, we no longer have a liquidity problem, that business might cease to exist. And that's when you have solvency problems, when those businesses go out. And then that just trickles down through, of course, all the employees, all the vendors, the landlords, et cetera, the banks who lent the capital to those businesses, the government that lent capital to those businesses. So those are some really challenging headwinds that we have to face, and we will face. I mean, it's really sad. This happens in all recessions. But a lot of businesses are going to go out, and we know that that's just part of an economic cycle. And in some ways, it really paves the way for stronger companies to emerge with stronger economies and future growth prospects. But it's not fun when we're in it, and we have to be careful about how deep that trough can go in this recession before you're looking at an extended recession, or what we've referred to as a depression. If you look at what some of the other market gurus have to say, so Jason Thomas is the CEO, investment officer of Savos Investments. He's a CFA. He has a PhD from Stanford, and his quote is, "Millions of Americans are thinking they're going to wake up from it. They're just going to go back to work or reopen their restaurant. It's becoming more and more clear that's just not how this plays out." So I think that is something that business owners are starting to look. We've been kind of gleeful about a potential reopening of the economy. And what does that look like? So if the economy is reopened, you can reopen your gym, you can reopen your restaurant, you can reopen your movie theater. How many seats are there going to be that are going to be filled? And can you run a profitable business? Certainly you cannot under the old construct. So I think what emerges from this is, if anybody, whoever stays in business, is going to have some really good leadership and figure out ways to restructure their businesses to be able to stay relevant. And that's going to be a big challenge for a lot of business owners out there and employers out there. And I think that's starting to become a sobering fact in reality that the business community is facing. And I'm not just talking about the stock market, of course. The stock market is talking about it. Jim Cramer said it well a couple of weeks ago. He's like, these are the winners. These are the winners. They are the biggest. They are the best. It's many of them. It's really hard to kind of take them out. When you think of what the stock market is, of how many companies exist in the country or the world, and how many companies are really available to buy into in the public. So of course, we'll talk about the stock market here in a second, but I'm talking more about the small and mid-sized businesses in our private sector. David Tepper also came on to CNBC this morning right after Jerome Powell, and I was watching it, and I think his comments had a even larger impact on the market than Jerome Powell's did. And so David Tepper is known as one of the most successful hedge fund managers alive. He's a net worth, I think, is reported around $12 billion and is a very successful investor. And so the market kind of listens when he speaks. And he said today that I would say it's one of the most overvalued, maybe the second most overvalued I've ever seen as of Tuesday. And he was referring to the stock market. I think that in that respect, there might have been a bottom put in, but that doesn't mean you can't fall significantly from these levels. So he was kind of just warning investors about the stock market. Look, the stock market is not cheap right now. And although, you've seen a lot of companies decline and it's cheaper than where it was, if you look at the companies and where they are today as far as earnings multiples and what he's projecting, he's saying this is a really overvalued stock market. So something for us to be wary about. Of course, we've spoken about this in ad nauseum and prior episodes. When you're looking at unemployment in America, of course, these are the really difficult numbers to look at. So Treasury Secretary Steve Mnuchin said the true unemployment rate is currently around 25%. The reported, those who have filed for unemployment last month are about 33.5 million, or 20% of the eligible workforce. For every 10 people that successfully applied, there's about 3 or 4 who could not apply, and 2 that didn't even try it because it was too difficult. So, again, it's 20% is what's being reported, but it could be 25% or higher of what the actual unemployment is. Kind of scary. The total employment of our country right now is 133.4 million. And that's the lowest we've had since March of 2005. So I think it was last week that we reported, or sometime in the last couple of weeks, that every single job has been lost since the Great Recession, since 2009. But when we go back even further, those unemployment numbers, it's going back to actually, pre credit crisis back to 2005 that we've seen these levels. And also to put that in perspective, and I believe in 1999, of course, we were in a really booming economy with a smaller population, but really on the height of economy, still about 130 million at that time. So, pretty sobering statistic, right? And again, I think what the Chairman Powell is saying, that, the longer that these people remain out of work, the worse it's going to be, the harder it's going to be to kind of put back these pieces of our economy. And it's really going to be important that we figure out some plan to allow things to open up and people to go back to work. When we look at the statistics, the unemployment rate by level of education, and this is important as far as where we are in the economy. And so what we're looking at is all workers who are 25 years old or older. Okay, so not your high school or college students, or those just out of college, but 25 years and older. And the red line is those that did not graduate from high school. This orange line is high school grads, no college, some college in yellow, and those with a bachelor's degree or higher in blue. So any of those who have children or grandchildren wondering whether they should go to college or not, or finish college, or go ahead and just email us. We'll send you a copy of this slide. I have one of my son's friends is saying that he's not going to college. He's made that decision in 8th grade. So I'm looking forward to sharing this with him. But anyway, so when we look at where we are today, I mean, if you look back to what unemployment levels were back in the last recession, we've exceeded those on all levels. And if you look back to those that had a college degree, we got to about 5% unemployment, and that's tracing to about 10% right now. And that was at the worst peak of what we were in the last recession before things started to get better from an employment standpoint. And so when, if you when I look at this graph, I'll attach, levels of income. Of course, there's lots of studies that suggest that, there's a higher wage commanded by those who've successfully completed more education. So if you could kind of think of what this means when this population is out of work, what that means for the economy as far as going out to restaurants, retail, commerce, hotels, clothing, whatever. It's pretty significant. And of course, many of them employing some of these other less educated workforce. And so we're at a staggering level that we just really haven't seen before. Seemingly we're not creating any new jobs at this point, and more unemployment is forecasted to continue from everything we can tell. So we'll continue to report on this. If you look at hotel occupancy, of course, this is uniquely hit, the leisure sector especially hard. And I mean, they were hit really hard in the last recession. And so this is showing that this solid blue line is kind of normal median occupancy of hotels. throughout a year. So in the winter months, in the beginning of the year and at the end of the year, it's less, of course. During the summer months, you kind of reach a peak in July, August, September of when people are doing their travel. So in 2009, you can see that we were, of course, off of the median. In 2019, this dashed line here, we were coming out of a really strong economy, and so much better than the median of the last 20 years that preceded 2019. And then here's where we are so far this year, right? And of course, again, it's uniquely hit us, but we're going into kind of peak hospitality tourism season. That's just likely not going to occur. And so, this is going to hit these kinds of sectors very, very hard. Unlike, again, it's unprecedented. We haven't seen anything like this. When you're looking at this number compared to 2009, and man, it was bad in 2009. I remember that very clearly, especially watching those numbers back then on the hotel and occupancy, specifically how severe it was. They're going to have a lot of challenges. So again, what does that mean? It probably means a lot more bankruptcies and adjustments, and we'll see how that plays out. But it's going to be very difficult for companies to stay in business that are built for occupancy that is around 70%, that maybe can withstand levels going down to 60 in the worst recessions and are currently at around 25. I mean, it's just the business model wouldn't work with those new numbers. Right. So a lot of different businesses, restaurants, and those kinds of things are facing very similar curves, very similar challenges. So the year-over-year change in retail sales. So this one, the retail sales has not dropped to the level that we've had in the last recession. And that's something. So this is year-over-year change in retail sales and food services, and does not include gasoline, which I'm sure is down quite a bit if you're looking at gasoline. But oil is having its own challenges there. So this is, again, retail sales, restaurants, food services. Over the last, 10 to 20 years, we've seen a massive migration and movement to online retail. So I'm theorizing that would is likely the case, is why you haven't seen this decline. Coupled with it our logical response to disease to go out and buy stuff here in America. So, toilet paper and canned goods and the like. So, we've seen a surge in buying certain things in retail, but, customers continue to shop so far, and we're in the early stages of a recession. And so seeing how quickly a recovery can come. But, if the recession continues and plays on, we'll see how Americans pull back on their budgets. I think that, the consensus that many Americans have is that their job is still waiting for them on the other side of this. Of course, the business has to exist on the other side of this. The school has to exist on the other side of this. So, we're going to have to see, how long and how the time plays out before that affects the American household's budget. But so still a dramatic decrease nonetheless. So, I think that there is, still a big disconnect with what the stock market's doing versus what's happening in the economy. And I'll continue to expand more and more on this because I think it's important for us to at least have a basic understanding. Because I think a lot of times what happens is when people see the stock market going up and all the economic news being really bad, kind of get disenfranchised and say that, this is just, it's out of reality. It doesn't make any sense. What the stock market is going to do is try to be a leading indicator of what's happening in the economy. And by no means is it going to predict the future accurately, but it will adjust to new information very, very quickly. And so it's going to tell you, what that information is that's coming in, good or bad, and kind of start to react to that. So we were talking about that last week, is all that information and the, what I know, what I know, I don't know, and what I don't know. And that's really all the information that we're tracking. And the stock market looks at information in those three camps. So do we as individuals, and try to make decisions. And, we unfortunately only have those two buckets of the known known and the known unknown that we can kind of put back and forth to try to make decisions. So that whole vast sea of the unknown unknown is what could dramatically affect the trajectory of the stock market, of our behavior, of all of those kinds of things. But what we look at here is the kind of a business cycle of expansion, the peak, a recession, the trough, and the recovery of the expansion. And so the economy in black here is kind of what we might experience as we go through an economic business cycle. Okay, so if you think of coming out of, the last recession in 2008, 2009, and it wasn't until really 2013 that you can call that we had a recovery. And that's kind of when we kind of got back to even and we had recovered. So the last recession took about 5 years to get back to even. And then when you look at, so that's what you saw in the stock market as well, the expansion, right? Kind of in the 7 years after that, and what we saw is the longest expansion that we've seen here in this country. And so here's what we'll have hindsight to look back of when the peak was, when the recession started, when the recession ended, when the recovery began. Of course, we can only kind of look back to see those things. And the stock market typically would start adjusting downward even as the economy was continuing to expand. This time around, we didn't get that opportunity. So it just seems like, the stock market started to sell off very, very quickly as we had bad news coming about this disease. Before the shutdowns, before the businesses were laying off people, the stock market did adjust. So we do need to remember that. Stock market was kind of leading into this thing. And when it starts to recover, we can still, we know that right now where we are from an economic standpoint is on this downward slide in the economy. Okay, so things aren't getting better. We know that. Things are continuing to get worse. We know that. There's going to be more bad news ahead. We are living through what's supposed to be the worst economic quarter of our country's history. Period. And everyone knows that. Everyone knows that this quarter that we are all living through right now is as bad as it's ever been, ever. And so what the stock market is trying to do is project out how far away this trough is and when we're going to get back to a recovery. Now, this dashed line is supposed to be an example of what the stock market is doing. The stock market doesn't look like that. It is reacting to news and data all the time and getting it right, getting it wrong along the way. And there's lots of movements. And I think something that I've said in just about every episode is there is going to continue to be a lot of volatility. And hopefully I've prepared you for that and telling you there's going to be a lot of really big green days, a lot of really big red days and weeks and months as we get through this. As the stock market is adjusting to new data that it didn't have a month ago, 2 months ago, 3 months ago. And so as we go through this, what we're doing as wealth managers is trying to work tirelessly to figure out, what data we have so far and what are the data points that we need into the future to have a better understanding of what the downside and the upside potentials are. And right now, David Tepper was also saying, as he addressed, the CNBC this morning, is that the risk reward trade-off is really warped right now. And there is a lot of downside risk in the stock market, as he was referring to, with not a lot of upside. And that's something that I've spoken to you about in many individual conversations. So nobody has a crystal ball. We can't know how these things are going to play out. We know what to look for, but we don't know which way the domino is going to fall. So we know economies are going to reopen. We don't know the level of resurgence of cases and if we're going to have to shut those down again. We don't know future measures that Congress is going to pass for fiscal stimulus. One of the things that a lot of the questions people had for Powell is, are we going to see negative interest rates? He's been pretty adamant that we are not, that is never in the conversation to go negative on interest rates, though he says they haven't ruled it out as something that they can use. that it's not a tool that they have in their toolbox and that they're pretty comfortable with their toolbox. So again, just kind of when we look at the stock market, it's not necessarily what we are experiencing now in the economy. What we are experiencing now is really, really tough stuff. And there's going to be a lot more economic bad news ahead. And what we're hoping for is a change in trajectory, some point in the future where a vaccine is developed, something that can contain the disease, something that can help us better trace those who are infected to spread, to contain the spread of the disease. Those are things that allow us to move forward with reopening the economy, and what's going to be really, really important for the stock market and the economy going forward. The other thing that has really led to this rally that you've seen in the stock market is, I do just want to mention that when we talk about the stock market, or when you do, you're probably looking at stock market indices like the Dow Jones Industrial, the Dow Jones, the S&P 500, or the NASDAQ. And you might know that there is a small number of companies that make up a big majority of these indices. And so when you're looking at, it's 1/20th of the S&P 500, right, at over 5.6%. Same with, those two companies are 10% of the stock market, those two. And you can kind of go down that list and add on. And so you're talking about 20% of, approximately 20% of the US stock market. If you refer to the S&P 500 as the US stock market, 20% of it is in 4 companies. These are juggernauts. These are massive, massive companies that are wildly successful, that will continue to exist, is what the market is essentially saying, by continuing to invest and buy these companies. In fact, in our perspective, one might argue that some of these companies can be thought of as even stronger than they were before, as they face a massive test that they are kind of working through. So a lot of companies are going to have to do that. If you look at, like, for instance, I think that their market cap, so the total value of all of their shares, I believe is around $1.5 billion, which is like 1/18th of what, it's just, sorry, 1/8. Did I get that right? 1/18th of what a small move in could affect the market more than, filing for bankruptcy, perhaps. So, that's also when we're seeing, like, the stock market is doing well. I think the rally, again, you'll probably know, is just in a few different names. And so, again, the overall economy and the overall stock market might be facing a lot more challenges. So, like, if you look at the S&P, of course, it had a bad time today. As of yesterday, it was down 10.6% on the year. However, only 20% of the companies in the S&P 500 were positive. 402 of them were negative. And 36, about over a third of the companies, were down over 25% on the year, right? So again, there's, in recessions, you're going to have a shakeout between winners and losers, and what are going to emerge are the very strong winners of our current economy, as well as businesses that we don't know exist yet that are going to thrive and come to be competitors in the future. So even though the stock market, if you kind of look at the market cap weighted index of the S&P, is only down 10, kind of the average or median return is down 17. The NASDAQ has even more concentration in the top 10. So 55% of the top 10 of the NASDAQ 100, which has 103 companies, mainly invested in tech and healthcare, is 55%. And I think if you, again, look at the top, 4 or 5 names, you're talking about just about 50% of them in about 5 companies once again. So concentration in these indices of what the overall market's doing, what the economy is doing, is a little bit disconnected from when you look at what the stock market is doing and know what we're tracking and what we're talking about when we talk about the stock market. So prior to today, the NASDAQ had been positive for the year, but only 38% of the companies were positive. So the index is positive, but only 38% of the companies are positive. About 1 in 8 companies were down over 25% on the year. So just wanted to kind of share that note about what we're looking at when we talk about what's going on in the economy versus what's going on in the stock market. I see some questions coming in. That's good. I'm coming to the end here. So if you have any questions, go ahead and put them in at the bottom of the bar. So again, the stock market is a wonderfully efficient mechanism for transferring wealth from the impatient to the patient. We know that this is the beginning stages of a severe recession and economic downturn, bear market, whatever you call it. And we're in the very beginning stages of it. So I encourage all investors, of course, our clients know, but everybody to be really patient because we have a long way to go. We have a long way to go in the stock market. We have a long way to go in the economy. We have a long way to go in the opening up California, to opening up the economy, to combating this disease, to finding an antivirus. Like all of these things are things that we look to the future and want to obtain, and we will. I fully believe that all of those things are going to be issues and problems that end up with a solution. And hopefully we can do that in a time that minimizes the damage. But we have to see, and we have to watch, and we're going to be here sharing our views and sharing this information with you every week to see, what we might expect. So I will just say, if there's any positive note, nothing that I shared with you is positive. But for our clients out there, I just want to say that we understand this and we're on top of this. Okay. And so there's a lot of scary stuff out there. We have an asset allocation model. You have a financial plan. You should have a lot of confidence in that financial plan because we have always talked about this. We have always talked about inflation, taxes, market crashes, and that there's going to be recessions, and that we have to have very long-term time horizons when we invest in risk assets like the stock market. And that we have solutions for your current cash flow needs and fixed income needs and midterm needs. And that's all part of your financial plan and asset allocation. So as your personal CFOs, fiduciary advisors, I just got to tell you, we are on top of this, and we are all working very, very hard on your behalf. So if you have any questions, you need some reassurance, you want to look at your plan to see if you need to change anything about your plan or behavior, please, I encourage you to reach out. Hopefully you've been reached out to. We've been trying to do our best and being really proactive, and of course, standing here with you every week and kind of sharing our thoughts of what's going on. So that'll do it for my share today. So thank you all. And I'm going to just give me a moment as I kind of read through some of the questions here. All right, I have a long one, but hold on. So we have a question. In terms of Roth conversions this year, are you looking at when is the best time to do this, or is timing irrelevant, impossible? So something that we talked about when in prior episodes is that in our when the market's down, what are the things we can do? And one of the advisable things could be to consider a Roth IRA conversion. So first is you have to take all the money that you have in pre-retirement accounts, IRAs, 401ks, SEP IRAs, pensions, etc., and know that those are what we call tax-deferred accounts. And if you've been to my class before, I've made you repeat that out loud because I don't think it's set in that we owe a ton of taxes to the federal government. And best believe now more than ever, they're going to be coming after it. So, a lot of experts and non-experts are all forecasting that we're likely to see higher taxation in the future. So in your lifetime, if we have to help service this debt in the economic expansion as we get through this bear market and we're printing money and all this fiscal stimulus, there's one argument that tax rates, can certainly be going up. So one of the ways to help, protect yourself from that is to get those tax-deferred accounts converted to tax-free, potentially tax-free Roth IRA accounts through a conversion. What happens is we're going to take money out of an IRA or 401k, and we're going to pay the taxes, but deposit it into a Roth IRA. And so the government allows you to do that. There's no limitations on how much you can do. Of course, you want to do it in an abnormally low tax year if you can, or certainly at least just a lower tax year than you would otherwise in the future. So those who, are taking required minimum distributions, you don't have to take one this year. So you're likely going to have less income this year than you would in any other year. You probably don't have to worry about too many large capital gains so far the way that this year is playing out. So this might be a really low tax year and a good year to consider Roth conversion. As far as the timing, well, it's hard to time the stock market because that's one thing that you can try to do, but that's very, very challenging and not something that we necessarily recommend that you do. But you want to, if you can convert your pre-tax retirement accounts to Roth IRAs when the market is down, you can potentially benefit from having those. If there's a recovery of those prices, then having those tax-free, that could potentially work out for your benefit. So as far as the timing, before December 31st is when you need to get it done. So I'd say work with your wealth managers. It's a very good question, but something that each individual should work out in their financial plan with their wealth managers. So great question there. So there's a comment that the economic expansion in the past was due to stock buybacks and the growth of the FANGs. And it's a long question, sorry. Okay, so I can just say that, yeah, stock buybacks are a big part of the growth of stock market companies. And I think there's a lot of misunderstanding about what that is. So if you own a company and that company makes a lot of money, you need to return that to the shareholders of the company. I mean, you're the owner of the company. You own that company. And so it's sitting there with a lot of cash. And so you can redeploy that cash to the owners of the company through a dividend. Or if there's some of those owners of the company that no longer wants to be owners of the company anymore, you can buy back their stock, meaning that you're going to own more of the company. So if you have a really successful company or a really successful stock market, theoretically, I would imagine you'd have a lot of stock buybacks. And that's just another way to return cash to shareholders. So that just means that companies were thriving and making lots of money. And so, yes, in a recession, you're going to likely see less of that. And also those who have gotten government assistance, and so forth, that there's limitations as to what you can do with your capital as far as dividends and stock buybacks are concerned. Okay, how does that kind of... So how does this economic response that we've had so far compare with other pandemics or recessions that we've had previously? So the economic responses that we've had so far are also unprecedented. So I think that it's really hard to look back to history with what we're going through now and say what worked before, let's do that again, because we just really haven't had this before. So it's uncharted territory. But so we, one could argue that the fiscal and monetary stimulus has met the severity, at least thus far. I mean, both have been unprecedented. So we've had unprecedented, economic job loss and economic factors that have been very, very bad. We've also had unprecedented stimulus that we've never seen before too. So those two should match. So if we look at the weapons, so to speak, that we deployed in recessions in years past, and those worked, those kept us out of a depression. Those allowed the economy to reemerge, for employment to be, full and the best it's ever been. So those weapons worked, and we're using those again to combat this economic disaster that we're in. The levels should be more if the economic disaster is more. So far, in my opinion, from what I'm seeing, that has kept up. All right. Any tips for remembering your anniversary? I don't know. I got it ingrained. Thanks for that one. If you need tips, let me know. If there was a vaccine tomorrow, how long would it take for everyone to get their jobs back? Would they all come back? That's a good question. If a vaccine was there tomorrow, so first, I don't think that that's even possible. So there is phases that a vaccine has to go through to be able to be widely distributed to the public. And as you might be aware, and I'm kind of out of bounds here. I have no medical training, and I've just kind of read probably what you have read about this. But obviously, you can have really dire consequences to releasing a vaccine that hasn't been properly tested that can lead to very, very bad stuff. Loss of life, death, loss of limbs. We've had some of that in the past in this country. And obviously, there has been a growing movement against vaccinations, which, current polls that we've cited in this cast have illustrated. So I don't think that we are going to be able to rush a vaccine. One, because the system doesn't allow us. Two, well, we probably shouldn't. And three, you're not going to get people to take it unless you've kind of gone through the proper procedures. So you have to the American public has to get behind whatever orders you're going to have. That's how we do things in this country. In China, maybe they can just line everybody up and shoot them with a vaccine, right? Seems like that's what would probably happen in some other countries. That's not going to happen here. And you're going to have a lot of skeptics and a lot of study that's going to have to make the American public really say that they believe in this and that they're willing to take it. So good question. So, however, I guess when that vaccine is distributed, how long would it take for everyone to get their jobs back? And that's I think what Jerome Powell was saying, is that the longer this plays out, the harder that's going to be, and the less likely that that's going to be. If the gym owner cannot reopen his gym in the coming months ahead, they will likely not survive. If the restaurateur cannot open for business and fully occupy their restaurant somehow, they're likely not going to survive. And businesses are going to really need to reinvent themselves in this post-COVID world to be able to be profitable and to be able to employ the staff and get demand from the consumer. And we have a lot of unknowns out there, a lot of unknowns. And so, I think we don't bet against America for not figuring it out. I believe we'll figure this out. And and we don't have all the answers, but I think some really smart, sophisticated people and hardworking Americans are working on this. The business community and the local governments are all working really hard to figure out new solutions to the current problem. But it's where everyone is kind of reacting in real time with new information and new data every single day. And so, although time is working against us economically, as that time goes on, we are getting more and more information that is making us better and making us more resilient and combating these diseases in different ways, other than just a complete shutdown of the economy. So we'll have to see. So, as time goes on, we'll see when those jobs would come back. I think if it happened today, I haven't looked into any study about this, but if everybody was vaccinated, you wave a wand and everyone's vaccinated, I think the economy can mostly just kind of go and be put back together. Probably with some very lasting changes that are going to be beneficial for local businesses, ours included, that this has kind of forced us to embrace new technologies. And there's been a lot of people that haven't embraced technology that, maybe many of you out there listening to this webcast, how many of you would have done this had we had a weekly webcast a year ago, or even a quarterly webcast a year ago? How many people would sign up? I mean, I wouldn't have. So I think that, there's going to be a lot of changes and we'll see how things go. But again, it's not coming tomorrow. If it did, that'd be great. We could probably put back the economy pretty quickly. But the longer this plays out, the less of those jobs are going to be available for people on the other side. Does Tepper's comment about the low being set mean he doesn't see the market breaking the previous lows again? Oh, so Tepper was saying that that's what he thought. No one knows, okay? No one knows about the lows. And so I get a lot of questions in these about, where the stock market's going to be in the short term, and no one really knows. We've seemingly kind of been able to kind of eliminate some of the really, really dire bad scenarios that were first being hypothesized when the disease just began to spread, and the overrun of the healthcare system and lots of really, really bad scenarios were kind of priced in to the stock market as a potential outcome. So I think what you've seen is some of those have been eliminated. So we'll see. So there'd have to be some new information that we don't have today, which is completely possible to for the markets to react as severely as they did earlier in the year. Again, I have no crystal ball, but that's kind of what you hear, what people are saying when they say, we think the low is in. We don't think that there's going to be an event worse than what we were imagining, 2 months ago. Now, we're certainly imagining a lot of good things happening in the future that might not happen, which could send the stock market down, which is kind of what you saw today. So we'll keep paying attention. But yeah, so that's where a lot of these experts are saying that the lows are in, and that but certainly a lot of downside potential is, I think, what his comments were today, that there's a ability for the stock market to fall a lot further than where it is today. And of course, we know that anytime we're investing in the stock market. So, well, thank you guys. Again, hopefully I warned you for the information I'm sharing with you today, but we'll be back next week. So we'll continue to track, some of that data on reopening the economy. Again, I really want to get a poll out to you, a questionnaire of what you'd like to see us add to this going forward, or anything you don't like that you'd like us to amend. So thank you guys so much for joining us and the positive chats and feedback. Thank you guys. All right. And I wish you very well. Have a wonderful week ahead, and we'll see you next week, 4:00 at the Presidio Perspective. And I'll have Gene Goldman with me. He's a really special guest. Don't miss it. We look forward to seeing you then. Thanks, guys.